What if I told you there was a single economic pattern that is repeated for the last century, and that this single economic pattern has preceded both crypto boom and bust cycles, as well as the wider boom and bust cycles we see in the stock market? The pattern I'm talking about is called the business cycle. And in this video, I'll reveal what the business cycle is, why it's critical for your investments right now, especially crypto, and pinpoint exactly where we are in the business cycle today. Because if you don't understand the hidden patterns at work in the business cycle, you might be blindsided by what it's flashing is about to come next. So what is the business cycle? The business cycle is a century-old economic pattern that is eerily consistent and perfectly lines up with every single crypto boom and bust cycle we've ever seen. And currently, this cycle is doing something unprecedented in the entire history of the business cycle going back a century. And I believe this has huge implications for what comes next. The business cycle can be broken down into 4 distinct phases. The first phase is expansion. This is when economic growth accelerates, businesses invest and hire, consumer spending rises, people are buying more stuff, they're going on more vacations. You might see inflation start to creep up a little bit, and crypto and stock markets generally do well. The second phase is peak. This is when the economy hits its highest point of growth. Inflation, may or may not be a little bit out of control. Labor markets are tight, aka it's kind of hard to hire people. There's more job openings than there are people to fill those job openings. You guys might remember that in 2021 during COVID, when all these businesses were having trouble finding people to fill positions. And it's generally at this point, the Fed's either starting to hike rates or they're talking about hiking rates. Phase 3 is contraction. This is when economic activity slows, businesses cut back on hiring and spending. Again, we saw this in like 2022, 2023, when Elon gutted Twitter. So you had a lot of other companies do the same, or like Mark Zuckerberg stepped up with Facebook, Meta. The stock was crashing, and he's like, you know what? We're going to stop wasting all this money on, the metaverse. We're going to start, firing all these people that are doing remote work and not doing anything. You saw a lot of the froth get cleaned out of the, all these companies during the 2022, 2023 market cycle. Consumer confidence falls. Everyone's complaining about everything being too expensive. Nobody can afford anything. Unemployment may tick up. In general, it's just like nobody's happy. Everyone's poor. Nobody's making money and life sucks. And the fourth phase is the trough. This is when the economy bottoms out. Unemployment, often peaks during this phase. Inflation often is very low or sometimes turns into deflation, and central banks typically start printing money, easing, maybe doing QE, cutting rates, etc. You get the idea. It's like the opposite of the peak top. It's the peak bottom where everything sucks, but then everything starts turning around. And of course, after the trough period is then the expansion period. It goes in a circle. So you have expansion, peak, contraction, trough, expansion, peak, contraction, trough. You get the idea. It's like a never-ending circle of life when it comes to business. Okay, this might sound super boring to you. This might sound super interesting, but it has huge implications for what comes next with crypto and the wider stock market. This is a century-old market cycle pattern and is doing something it's never done before. And I feel like when something has 100 years of history and it does something new for the first time, you probably should pay attention to that new thing. Now, there are a lot of ways to track the business cycle, but I think the all-around best measure and probably the easiest way to visualize the business cycle is the ISM Purchasing Managers Index. And as you can see, this chart goes all the way back to 1948. And just looking at it, you can visually see that this is one of the most eerily consistent patterns in all of the markets. I mean, it literally looks like a heart rhythm. It looks like a person's heartbeat. It is the heartbeat of the markets, is what maybe some people might call it. I don't know. I feel like maybe I just made that up, or maybe that's what people call it because it does look like, like a heart rhythm chart. And just to kind of visually break it down for you, this would be a contraction period. This would be a trough period. This would be an expansion period. And this would be a peak period. You can see it just ebbs and flows between these peaks and troughs. And it is so eerily consistent and rhythmic. It just consistently does that over and over and over again. And again, we're looking at a chart going back from 1948, the one we're looking at, all the way to today. And the line to watch here is 50. So I put this little marker at 50 so you can see it, but the line here to watch is 50. Under 50, think of it as like, oh, recession, bad, economy's not too good. Above 50, think of it as like, oh yeah, money's flowing, people are feeling good, people are buying Lambos. That's kind of like what that line separates. It's like happy, sad, and depressed, okay? And as you can see, okay, the first crypto bull run we had in 2013, right? And you can see this is during a period of expansion. You have this period where the market, the business cycle is doing well. You have this period of expansion. We're sitting above the 50 line. And then what happens? We have this period of contraction, markets melt down, crypto doesn't do well. And then, we start into this new period of expansion going into 2017, where we had another crypto bull run, followed by a period of contraction where we had another crypto winter, followed by another period of expansion going into 2021. So you can literally look on this chart and be like, okay, crypto bull run, crypto bull run. Those are the crypto bull runs. These are the crypto bear markets. Okay. And this chart has nothing to do with crypto. There's no ounce of crypto in this chart, but it perfectly shows you when the crypto bull runs were, and it perfectly shows you when the crypto bear markets happened. And you can see, right here is 2008 financial crisis. You can see the dot-com bubble happening and then collapsing. And you can see that it happens in rhythms. Okay, so we go up, we go down, we go up, we go down, we go up, go down. And if you wanted like just the most stupid, simple way to play the market, you could just be like, okay, buy when we're going into the up expansion phase, sell when we're going into the down contraction phase. And it's going to be rhythmic and consistent because you can see that this goes all the way back a century and it just goes up and down like a heartbeat. It's not like this pattern's like, 5 months old or 2 years old or 5 years old or even 10 years old. Like this is a long-term, really eerily consistent pattern that marks the tops and bottoms of major bull runs, major cycles that even predate crypto. It's actually kind of insane and almost a little bit spooky how accurate and this is. And the cool thing is this precedes these market events. It's not like it just tells you what happened after. The cool thing is it precedes, but even if it didn't precede these things that happen, you can see that it's a consistent wave. It's literally just a consistent wave heartbeat pattern that you could just be like, okay, here's the top, here's the bottom, here's the top, here's the bottom. If we're sitting at a bottom, we're probably going to a top. If we're sitting at a top, we're probably going to a bottom because that's how this pattern likes to roll. Okay, so what causes the ISM index to go up or down? Well, directly it'd be like, it's going up because companies are getting new orders, they're hiring more workers, they're getting more business, etc. And it'd be going down if they're getting less of those things or having to lay off people. It's not going good. But those are just like the first order obvious things, right? Behind the scenes, there's a lot more at play that's kind of driving this cycle and this consistent pattern. And you could say probably the main driver is government liquidity and debt cycles, maybe some of it's psychology. But basically, when you give people the same set of incentives, they just do the same thing every single time. So if they have abundant credit, there's a ton of liquidity, the business is going to pump up, people are going to spend a lot of money, the business cycle is going to go through the roof and skyrocket. But of course, when everyone's making money, they're going to leverage up. All this kind of bad stuff's going to enter. People are going to get lazy. They're going to hire too many people. That's going to ultimately lead to the collapse of the business cycle, which is going to cause this huge trough. The trough is going to cause people to get laid off. They're going to clean up shop. Obviously people are going to want to survive. Credit and all that kind of stuff's going to reset. The Fed, government's going to step in and be like, hey, we need to fix things. We need, more abundant credit. We need more liquidity to pump in. So they pump that back in. And then it causes the whole thing to happen over and over and over and over and over again. And you can see just even looking at the chart that like, over the last century, governments and people have gotten a little bit better at this process. You can see it used to be really, really volatile in these really insane cycles, and they've kind of muted them over time. They've gotten better at kind of controlling them and making them not as extreme over time. But we still have the basically same pattern playing out because when you give people a certain set of incentives, they're just always going to do the same exact thing because human psychology never changes and it hasn't changed for the last couple thousand years. It's not going to change for the next couple thousand years. Now, that being said, as mentioned earlier, recently, the business cycle has been doing something unprecedented in the entire, century-long period of tracking the business cycle and how it's played out. And honestly, you can visually just see it looking at the chart. If you look over here, this is us now, and you might notice that, one of these things is not like the others. Specifically, you might notice that for all of history, it's gone up, down, up, down, up, down, up, down, in a very consistent pattern. But recently, we went up in 2021, and then we came down, and we just kind of stayed down. Right? We got like this weird W looking thing over here, and we're just kind of staying down over here in the gutter, where in the past we had these huge contraction periods, but then kind of bounced back up. We didn't really do that. We just kind of fell down here and died. This is in fact the longest single point in history we've ever stayed below the 50 line. And to be clear, I keep saying a century's worth of data. I'm talking about the business cycle. The ISM index only goes back to obviously 1948. It's not quite a century. It's kind of close. It's close enough, whatever. I'm going to say a century because it sounds way cooler to say century than, whatever the name of not quite a century would be. We get the idea. It's a long period of data. We have a long period of data going all the way back to 1948. And not in that entire span of time have we had as long of a period below the 50 line as we have right now. Not during the dot-com bubble, not during 2008, not during the Volcker period. Never before have we had a period below the 50 line as long as we have right now. And the way I'm measuring this is I'm not counting these little weak, gasps of air where maybe it kind of blips over for a second and, tries to breathe a little bit. I'm not counting those when I'm measuring each point in history because obviously that isn't a real expansion in the business cycle. It's like more of a fake out, like it's trying to expand, but it doesn't have the strength to do it, and then it dips back down. So we're not counting those little tiny, gasps per air, which would make this a 29-month period ongoing where we've stayed in this kind of contraction period of the business cycle. The second longest period is 24 months, and this is during 1981 to 1983 during the Volcker era. Okay, so which is really interesting because that's also another period where inflation got out of control, and Volcker stepped in to try to tame inflation with really high interest rates. And that's the second longest period where the PMI was below this 50 line, was a similar time where inflation got out of control. Similarly today, inflation got out of control. A lot of people say Jerome Powell's channeling his inner Volcker, where he's trying to be tough on interest. He's trying to keep rates higher for longer, that whole thing. And so it's really interesting that, the market draws a lot of parallels to the Volcker era and Jerome Powell. And we're having, and that happens to be the second longest period when we were below this 50 line. You had the dot-com era, which is about 20 to 24 months where we were stuck below the line. You had the 2008 financial crisis, which was about 15 to 17 months. Then you had the oil shock and stagflation in 1974, which was about 14 to 16 months. And that's actually crazy when you think about it. The 2008 financial crisis, the Volcker era, the dot-com bubble, the oil and stagflation crisis of the 1970s, all these things were like these insane, crazy, world-shattering events. And yet today, in 2025, we are currently in the longest streak below this 50 mark that there's ever been in all of history. And just to pause really quick and highlight something, during the Volcker era, you can see it went down like this, and it stayed, below the 50 line, and it did peak up. It obviously went higher than just little peak up, like these ones. It went all the way up to 58, but it was kind of a short peak. It went, shortly up, kind of went down, up, down. So if you count this whole era as like one period below, that would technically be longer, sitting in around 36 months under the line. But obviously it didn't sit under the line. This was a pretty good break. We don't have anything even like that today. It went all the way up to 58. And you can see today, like the closest we've gone is like, we just kind of like tickled the line. But maybe you say, it was short and it went to 58. Maybe that's somehow, you want to count that all the same. Even if you did, this is still unprecedented because again, we're just those ones had the bounce. They like bounce back and forth. This time's not even having that. We fell down and we're just like staying dead. We fell down to below the 50 line and we just can't even get back up. We don't even have the strength to push back over that line. The economy inhaled in 2021 and then it just never exhaled. It's just been holding its breath ever since. And you know what happens when a person's holding their breath for a long time? Eventually, they need to breathe again. Now, I was really curious, after these long periods below the 50 line, what happened with the stock market? Because obviously Bitcoin didn't exist back then. We couldn't, measure that and see what happened. So the closest thing would be the stock market. What happened with the general market after these periods? Did any of these periods have specifically really strong rebounds versus other periods? And what was really interesting is the strongest rebound period was, in fact, the 1982 Volcker disinflation period. So after the business cycle bottomed in that period, from the bottoming of that cycle, you saw the strongest returns out of any single one of those periods. The reason I thought this was interesting was because, again, this is the second longest period before the current period we're in, and it is the most similar because it was all about inflation. It was all about inflation getting out of control and raising rates high to tame inflation, which is exactly what we're going through today. And you saw following this really long period of sitting below the 50 line, this absolutely insane rebound in the markets where everything took off. And if history repeats, if this is like an indicator for what happens next, that would mean that as we start to enter that expansion period, we should see an absolutely unhinged, insane rally in equities, including crypto. And we know Bitcoin and crypto are extra sensitive when it comes to moves in liquidity, which means we could see particularly strong performance in crypto. So where are we right now in the business cycle? Well, we're currently in uncharted territory considering we're in the single longest stretch sitting under this 50 line. Considering that, it does feel like we are due for a turnaround anytime soon. But if you actually look at the chart, there's absolutely no hint of a turnaround. As you can see, it's actually headed down lower right now. Ultimately, we need a lot of things to shift macro-wise in order to see this turnaround. So we need maybe the Fed cutting rates. Maybe we need some QE coming into the market. Maybe we need some deregulation in the market. We need the credit cycle to hit, which I talked about in another video where we are in the credit cycle, what the credit cycle does as far as the markets. If you want to check that video out, it's not just one thing. There's a lot of things that need to shift in order to turn the economy around and enter that expansion phase of the business cycle. And what's really useful about the ISM chart isn't that it tells you exactly when, the market's going to go up. It's more telling you what's going to come next. For example, as you can see, we went through a trough period. This led to an expansion period, which led to a peak period, which led to a contraction period, which led to another trough period, which tells us next up is another expansion period. And again, if the Volcker era is any indicator, this next expansion period for risk assets could be absolutely unhinged to the upside. Again, it's worth checking out my credit cycles video where I talk about specifically just the credit cycle, as well as I do a video on the 4-year cycle where I go into a lot of different cycles and kind of how they're coming together. If you put all this together, this is what I'm talking about when I keep saying the macro picture is insanely bullish. Everything feels like it's primed for an absolutely unhinged, insane rally. When it comes to crypto and it comes to the wider market as a whole, we're just waiting for when. We're waiting for when this thing's going to happen, but it's like a spring being coiled. I don't know when that spring's going to just launch, but it sure feels like it's coiled for an absolutely insane move to the upside. As always, none of this is investment advice. None of this is me telling you to do anything with your money. I'm not your dad. I'm not your financial advisor. You are a grown adult with free will who can do whatever you want with your money. I'm just a random guy on YouTube talking about what I'm doing with my own money, what I'm interested in, and what I'm up to. If you're interested in joining the Obsidian Council, it's currently closed to new members, but you can join the waitlist in the description of this video. In the Obsidian Council, I do weekly market and macro updates. I share my entire portfolio, update every time I buy and sell. I do monthly market deep dives, weekly Q&As, and a ton more. Again, you can sign up in the description of this video. If this video was helpful, make sure to hit that like button. If you have any questions or comments, let me know down in the comment section below. And if you want to see more videos like this, make sure to hit that subscribe button and the little bell next to it to be notified each time I release a new video. Thanks for watching, and I'll see you next week.